Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, February 21st, and then we'll see how things look for Thursday, February 22nd. We ended up having an up day. Well, we started off lower and we chopped lower, and then the FOMC meeting minutes came out, and the market really didn't react to that because there was really nothing new that was said in the meeting minutes. But then, with about a half hour left to go in the trading day, we saw a lot of buying coming in, and that drove the index back up, and we actually ended up closing positive. On top of that, NVIDIA did come out with their earnings report. It's being very well received, and the futures are up quite strong, anywhere from 0.75% to 0.8%. Now, this is about 8 hours before the market even opens at the time I record this, so anything can happen between now and then. Another thing to be aware of with NVIDIA, the last time they came out with earnings, they had a blowout report just like this time. It gapped a lot higher in the overnight session, and then once we opened for trading, everybody just started selling, and by the time we got done that day, NVIDIA was pretty much unchanged. Now, I don't know if that's what's going to happen this time, but it did happen last time, and it's just something to be aware of if that's a stock of interest to you. This could help give the market some support if we see follow through into the cash opening, but at the same time, we're still seeing weakness developing. We didn't see enough of a bounce, and it ended up being a mixed day with the Dow and the S&P being higher. The NASDAQ 100, the NASDAQ ended up being down. We're seeing some weakness again in mid caps and small caps. So we still need to respect what's happening on our charts, but at the same time, there could be some good news that's coming into the market. So let's go back and talk about what happened. Right at the open, we did have a lower open, and then prices pretty much chopped sideways. There were this idea that it was wait and see to see if there was anything new that was going to come out from the FOMC meeting minutes, and nothing really new did come out, but the market was pretty subdued ahead of that. Then we eventually fell below S1 at 49.56. We rebounded. We got all the way down to around the 49.50 level, another round number. And then we ended up seeing this bounce back up where we got above the daily pivot at 49.75, and we ended up closing positive on the day. We were up 0.13% on below average volume. That's another thing that we've been noticing. On up days, we see below average volume. On down days, we see above average volume. Now, a lot of this came right at the end of the day, and even if we had closed negative, it might have still been below average, but we still need to pay attention to what we're seeing on a more consistent basis. We are still positive when we look at all of our charts, but we're coming down. We're showing some weakness. Now, a lot of our charts did bounce a little bit because they're calculated on the closing value. And when we have an upward close, that improves some of our indicators slightly. Some comments that we can make, we're still below 5,000 with the S&P, and for right now, the 20-period moving averages are continuing to provide support. So in this context, that means that we're going through a pullback, at least for right now. NVIDIA's report was well received, and we'll again have to see if that ends up going through into the cash session. The FOMC meeting minutes really didn't reveal anything new. I pointed this out in yesterday's video. Just to be aware of this, Amazon will be replacing Walgreens in the Dow on February 26th. On a short-term basis, we still have our longer-term stochastics chart, which means long-term, short-term there. That's extreme positive, but it is starting to come down. We still have the Stoch RSI, which is extreme negative after we had the down day yesterday. On an intermediate term basis, we're still keeping an eye on our oscillators, which are still extreme positive, but they're showing more weakness as they're rolling over. And we still have our 10-period new high, new low study for the S&P. So not a very long list here. Some of these things are adjusting. Some of these charts can take a little bit of time to read. So we're not necessarily getting an overwhelming amount of either extreme positive or negative readings right now. But when you look at the longer term, we're still extreme with the 150 and 200 period simple moving average. The parabolic SAR continues to be negative. We still deal with this same basic scenario that it does look like the Fed is done raising rates, and that at some time in 2024, they will entertain the idea of cutting rates. We're not exactly sure when that will be, The dollar was up and interest rates were also up, and that was putting some pressure on stocks earlier in the session. We closed at 4.33% for the 10-year yield. We still have the yield curves that are inverted that we've been watching for a long time now. Sentiment did tick back up right at the end of the day with that upward move. We went to 70 where we had been at 67. So we haven't gone into extreme positive territory yet. That's when we get to 75, and I have to clear my throat. Then the condition of our trend, not a lot has really changed here. We still have our ADX chart suggesting that we're in a trend because we're above 20. However, both charts are below their moving averages, so that could suggest a weakening trend. And with both charts, the green lines are on top, so that is a positive weakening trend. I've switched our bias back over to mixed, even though we had the up day. A lot of that came right at the end of the session, and that's good because it's the professionals who close the market. What we need to see now is more follow through. It just seemed to kind of appear out of nowhere where we saw some buying coming in. And I'm keeping our momentum at mixed right now just because the last few days we've started to see some weakness enter into the market. We did get the weekly MBA mortgage applications index. It was down 10.6%. Last week, it was down 2.3%. Here's a chart. And as interest rates are going back up and housing prices continue to go up as well, this is putting pressure on the ability to get a mortgage, whether it's a refinance or a new mortgage. And we are in the winter months. And in some areas, it's probably hard to go out and look at houses when it's snow and cold, and summer times when it's kind of fun to go looking at houses. Here's some Isabel net charts. This is the ZWAG NYSE breadth thrust, and I cover this in the weekly videos because this is a very rare signal that was generated almost a year ago now. And according to this, it has a perfect track record, especially when you look out into the year. And you can see the results over here on the side, even though I tried to blow this up and make it easier to see. Just know that when you go out a year from now, it has 100% accuracy as for positive returns. And this is the actual chart itself. I'm showing it now because of the other chart that we just had. We had the first ZWAG breadth thrust triggered back in March, so we're coming up on that 12-month period. But then we had another one that was triggered back in October. And these are very rare signals, and then to see two of them within such a short period of time of each other is really, really rare. Then here is the truck tonnage index. For some reason, there's a correlation between what we see in the orange line here where it's going down and the S&P 500, which is the purple line. They tend to go more hand in hand with each other, but since the COVID lockdowns, we've seen a real disconnect between the two. And the fact that this is going down, is that causing some concern, at least economically? Then another thing that we keep an eye on is short interest. And there's a couple of different ways I have to explain this. When somebody wants to short the market, they sell to get in, and with the idea that prices will go down, and then they have to buy to get out. Now, when there's a whole lot of people doing that, in one viewpoint, you can mean that there's a lot of people that are shorting either an index or a stock or something, and that means they're negative. And sometimes these people are, I wouldn't say smart, but yeah, they're smart, but not necessarily experienced, because shorting can be really risky, because theoretically a stock can only go to zero, but it can go up to infinity and beyond. And when there's a lot of people that are shorting a position like a hedge fund or some of the more smart money, sometimes we want to notice that, and that can have more of a negative context behind it. At the same time, when there is a high short interest ratio, that could mean that if prices do move against these folks, because it's a lot more risky to short things, they have to get in. They have to close their position. They can't ride it like they could a cash position. They have very stringent margin requirements, and they have to get out. Well, to close out that position, they have to buy. And when you see a lot of this happening at the same time, we call that a short cover rally, and where prices just seem to go up and up and up, and they're out of control, and you're not sure why they're really bouncing up the way they are. That's more on the positive side if you're long in the market. So when they come out with this at 1.7, that's a pretty low reading overall. You can see where we were at before, especially during the great financial crisis. There was a pretty hefty amount of short interest in the market, and it's been dropping off, but it's been coming back up again right now. The interesting thing too is there's other ways to short the market. I short the market all the time. I don't do it this way. I use put options, or I use inverse ETFs, or things like that are less risky from a margin requirement standpoint, but you can still participate in downward movement. So maybe that's why this percentage is dropping rather low. Then here is the current reading from Goldman Sachs with the S&P, where we're at, and then the earnings per share. They're still looking pretty rosy going out into the future, which is justifying the S&P going up in price. And then we did get the LEI. I showed you the chart. This is a day after now, showing some annotations here on the chart, where it said it did not signal a recession in January, as 6 out of the 10 components contributed positively. So we are seeing some improvement coming up here. Now, usually when we drop below this red line, that's when we go into a recession. We've been below the red line now for quite a while, but at least to this point, a recession has not happened. Then we look at the index margins, which take out tech. So we're trying to take out the big mega caps mostly. And it says it will only expand modestly in 2024. So here's the green line, info and tech. Those are the big mega caps, and that is still going up for them. If you take them out, we're going up, but it's not going up as fast. And this also just feeds into that thesis that we've been developing here, that it's really the mega caps that are driving things higher. And they're also anticipating the S&P going up as well. Here's our intraday chart. We did have a lower open, not much of a gap. We just chopped more or less sideways along this moving average that I have plotted here. We did get down to S1, but then bounced right back up. Then the meeting minutes came out. We gyrated a little bit, and if anything, we were more negative. And then right near the end of the day, this is when we saw some real buying coming into the market, enough to close for the high on the session and enough to take us positive on the day. So here's our 10-minute intraday chart for the SPY, where we were negative in the pre-market session. We chopped all around, did show some weakness later in the day, and then some strength. And then this is the market reacting pretty much to the NVIDIA earnings report. And it's up pretty strong. And based on this, that would put us back above the 5,000 level. But like I said, this is 8 hours before the market even opens, and lots of things can happen. Not only before the market opens, but we have to watch the price of NVIDIA after the market opens. We are still seeing where the blue line is under the red line on this intraday chart. That just means that growth is underperforming value, even though they both, they didn't really close up. They closed up a little bit here. So they're showing a bit of an improvement there. We're also seeing some more sustained weakness when we looked at the growth to value ratio for the S&P 500. We are underperforming right now when we compare growth to value. Here's an end of day chart where growth ended up being down, value was up. Growth was also down with the mid caps, where it was up with the value for the mid caps, and it was down, but not as much for the small caps. So looking at our growth to value charts, here's the small caps where we're continuing to show some more weakness after we had been breaking out. That's a little bit of a concern. We're also showing more weakness with the mid caps, also a bit of a concern there. We're also coming back down with the S&P growth to value ratio. That's also a concern. We want to see all of these charts turn and go back up for us to be more positive on things. We ticked back up just barely here when we compare discretionary to staples. This is still positive overall, but we want to see this turn and go back up as well. Here's our trend where we're still dropping below the moving average. That suggests a weakening trend. However, we're above the static number of 20. The green line is declining, even though it is still on top. We're seeing pretty much that same thing in the short term. So the short and intermediate term continue to confirm each other. We're also dropping off when we look at the last number of days together based on volume. We didn't really change all that much with the Ulcer Index. It's not really giving us an awful lot of insight. We did end up ticking down just a little bit with the VIX. That was the late day strength that we saw. And we're climbing above that 15 level, and we're above the moving averages with the VIX, both with the line chart as well as the bar chart. we get a little more concerned, at least in this type of an environment, when we start to climb back above that 15 level. And we're actually seeing a little bit of a decrease with the VIX of the VIX, where it turned down, but we're still above the moving averages. And here's the momentum of the MACD, which has been higher since the first part of December, where we're seeing the momentum of the mix of the VIX starting to pick up. And we did go up with the equity put call ratio on the daily chart, and we're turning back up. It's probably a little easier to see now with our 5-period equity put call ratio. And we're still getting an extreme reading with the VIX to S&P 500 correlation. We haven't dropped down from this extreme reading yet. And quite often that ends up being negative going forward. The skew index is no longer in this red area. It dropped. It was actually a little bit below the red area yesterday, and it's continuing to drop right now. If we continue to drop, I'll probably stop showing this chart. This is really not telling us much. We did get the latest reading from Investors Intelligence. We're getting an extreme positive reading when we're looking at sentiment. And just an update of the Hindenburg-Ullman. This is how it's calculated over here on the left. When you take these readings that we get, sometimes it only has about a success rate of 25%. But I've kind of concluded, kind of had a little change of heart with this, that since I look at anything and everything to try to reach a conclusion, why not include it in the overall practice? My problem is when an entire scenario is developed around this chart, and that's when people can really be led astray. Here's the update where we did see a spike. This is not confirmed yet. We need to see another spike for this Hindenburg-Ullman to actually confirm itself. And the initial signal was right at about the beginning of February, so we have up until about the beginning of March for the next signal to be generated to confirm that. If we go longer than that, then this will be just a spike that didn't go anywhere. Here's our advanced decline line. We ticked up a little bit based on price and volume. Not a big change there. We are starting to turn back up with the new highs on our 5-period, and we're just slightly going up with the 10-period. We did tick up a little bit with the advanced decline ratio, and these are the charts that tick over and turn up when we have a positive close. Accumulation distribution is turning back up above an advancing moving average. This is a smart money indicator, as is the Chaikin money flow, which is continuing to decline, but is still positive. And we ticked up just a little bit with the Chaikin oscillator. Our advanced decline line studies, we were up a little bit with the NYSE, the S&P, the mid caps. We still declined when we look at the small caps. Here's our daily chart where we're still dealing with that trend line, and I have a blowout chart here to show you that more in detail. And we did remain below average with volume. Here's the Stochk RSI, which is extreme negative. The 20-period moving averages are now continuing to provide support, and they've done a pretty good job in 2024. Can that continue? This is what we're going to be watching. For some reason, if we start to drop and we're going to close below the 20-period moving averages, that's going to shift this even more negative. But for right now, it's just looking like a pullback. We did turn up a little bit with our 2050, and we're climbing barely with the 200-period exponential moving average. We did tick up just a little bit with the force index, so we're slightly positive there, but we're still below a declining midpoint. We're no longer extreme in the short term, intermediate short term. We're declining, but still extreme in the long short term. And I like to explain this. This is a further subdivision of the short term time frame. We're not extreme, and we're still above the midpoint with the standard deviations chart. We're also still finding support with our 20-period moving average study here, looking at this mini rainbow. And we ticked back up with the balance of power, and we're above the midpoint. That's positive. But we have switched over to the lighter shade of blue now with the go, no-go system. That's positive, but it's more neutral positive. And we're just about at the midpoint still with our highest high value. The TTM squeeze does continue to decline with the darker shade of blue. So that's positive, but showing some weakness. We ticked back up with the ease of movement, and we're still above zero. We were flat with the Arun indicator. We're still negative here with the S&P McClellan oscillator, but it did tick up. So we are still continuing to decline based on price, and we're also declining based on volume. This is part of the weakness that we're potentially seeing develop that could end up leading to lower prices for the index. We did drop below zero with the NYSE McClellan oscillator, so it's really hard to see, but we're starting to turn down based on price, and we're still, looks like, advancing here with the NYSE summation index based on volume. The Swenlin trading oscillator did turn back up above zero. That's positive. We crossed back above zero based on volume. That's also positive. And here's where we're running into some cloudy issues with our oscillators. We're below the moving average and declining with the PMO. That's negative, but we're getting an extreme positive reading. That's positive. We're also seeing a negative divergence, which of course is negative. We're pretty much on the moving average when we look at it based on price, and we're still dancing along the moving average based on volume. We ticked up a little bit with the PMOs that are rising. We saw a bit of an improvement with the buy signals, and we're flattening out and trying to turn up with the PMOs above zero. We remain neutral for the Elders Impulse system for the S&P. We remain negative with the parabolic SAR. We are declining and just coming down to a no longer extreme positive reading with the slope oscillator. This is our shortest term oscillator, and it tends to be the touchiest. Where we are rolling over with the MACD, you can also make a case for this longer term negative divergence. So with all of our oscillators coming down with the slope, the TSI is starting to no longer be extreme. We're rolling over with the MACD, the PMO, and the PPO starting to show some weaker signs longer term with the TRIX and the KST. So momentum is starting to shift more negative. But we're still above all the plotted moving averages in our moving average tree. We continue to decline with the bullish percent index for the S&P. We also ticked down a little bit with the NYSE bullish percent index, and we're continuing to decline with the NASDAQ 100 bullish percent index. The money flow ticked up just a little bit and is still above 50, where the ultimate oscillator also ticked up and is above 50. We turned back up a little bit here with the vortex, and the green line is on top. We flattened out. Well, we're flat here with the RSI based on 14, and we're flat with the 9-period RSI. We're still positive with unbalanced volume. We're above an advancing moving average. We turned back up a little bit with the stocks in the S&P above their 200-day moving average. Also, we ticked back up with those stocks above their 50-day moving average. The Copic curve, though, still continues to be negative. We're no longer extreme with the Sean trend meter. We're still looking more negative with the Heiken Ashi with the black candles. We're still positive with the Kegi, but we continue to be pointed down. The Renko chart is just going along like everything's hunky-dory. And we're actually switching back a little more positive here with the 3-line break. Long term, we're still below this trend line. We had now broken below that. If we do see an upward thrust, this could end up acting as overhead resistance. If we can get back above this and close above it, that would turn things more positive. If we start to fall from here, we're probably looking at going down to the 20-period moving average. If that doesn't hold, we would then look to the 50-period moving average. We're still extreme with our 150 and 200-day simple moving average study. And we switched over to negative with the NASDAQ 100 in the short term, but all the other time frames and indexes are still positive. Here are the alerts. There was a lot of red that was generated earlier in the day, but hey, Canada set a new 52-week high. And the equal weight actually did a little bit better than the S&P 500 weighted index. That's why we're seeing our ratio coming down slightly here. The Dow is pretty much chopping more or less sideways. It was negative for most of the day and was able to eke out a slight gain, but it still remains neutral with the diamonds when looking at the Elders Impulse system. We were down with the NASDAQ, even though we closed near the top part of the bar. And the same thing with the NASDAQ 100. We were negative, but we closed near the high end of the daily bar. But we're still negative with the QQQs when looking at the Elders Impulse system. The momentum for the NASDAQ 100 continues to be negative. Small caps ended up being down, but we're just a little bit above the 50-day moving average with the small cap index. We've switched from being neutral over to negative with the small caps when looking at the Elders Impulse system. We're still above this now support level here, that the small cap, the Russell 2000 small caps, they've had a really hard time staying above this red line, and we're still above the 50-day moving average. The mid caps ended up being up slightly, and we're still above this R1 pivot level, but they remain neutral with the Elder's Impulse system when looking at the mid caps. The FANG index ended up closing down, but we're still really close to the all-time highs. The financial sector was up and is still in an uptrend. And we were down a little bit over 4% with New York Community Bank. Then the dollar still above both of these moving average lines. The longer we can stay above this, we might see a golden cross. The fact that the dollar has been rebounding since the early part of 2024 has been putting pressure on stocks. We were up with the 10-year based on yield. We were down with the 10-year based on price. We're still hanging out above the 200-day moving average. And then looking at our growth to value studies here, we're showing some weakness with the Qs compared to the S&P. We're coming back up to the moving average, and we have been going flat here with discretionary to the S&P. But now we're starting to drop below the moving average when we compare large cap growth with large cap value. So with the large caps, we're seeing some weakness, mid caps, and we did decline with the small caps, but we're still above the moving average. We're still positive when we look at the 5-period moving average of the highs minus the lows, and then spread that across the broad market. We're also still extreme positive with our 10-day average of the S&P 500 highs minus the lows. So our outlook, we're still positive here, but we are showing some signs of weakness. We also have to respect the idea that we're now in a period of weak seasonality. We're going to get weekly jobless claims. We'll get the S&P Global U.S. manufacturing as well as the services PMIs. This will be the preliminary reading, not a big influential report, or I should say reports. Existing home sales will come out. So it's probably going to be weekly jobless claims that are the big one. And then we want to watch all the geopolitical events that the market just doesn't seem to pay attention to. We will not be getting any economic reports in Friday's session. Seasonality. We're neutral to negative with the Dow and the NASDAQ, where we're flat out negative with the S&P. So from 2002 to 2022, seasonally on February 22nd is rather negative. We are still in the middle of options, the week after options expiration, where we tend to be more negative than positive. This is the negative seasonality going into the latter part of February. This is the same chart, but it looks further out for the rest of the year. We also are looking at some more weakness with the Stock Traders Almanac. Also, this other study put up by the Stock Traders Almanac suggests that we might see some weakness going forward for a while. February is the weakest of the 6 best months, even during an election year. Thursday is one of the more positive days, not the most positive day, but in 2023, it was up. And then looking at the 15th trading day of the month, where we do see some positive seasonality here during an election year for the S&P. And then Tom Bowley is still suggesting that we're in the latter part of February now, where we tend to see more negative results. So our scenarios, not going with the down one, even though we are seeing weakness developing and we are dealing with some weak seasonality. We're not seeing a shift over to a negative environment yet with our charts. So if anything, we still lean more towards the positive side, but be aware, we are entering a period of weak seasonality. We're not going with the sideways trend right now because both of our ADX charts are suggesting that we are in a trending environment. And this is another scenario that we've been seeing for the last week to week and a half, where volume has been decreasing as the S&P goes up. The risk-on posture is not helping us right now. We're going back up with the equity put-call ratio based on 5 periods. The oscillators are dropping below their moving averages. They are extreme positive, but they're starting to roll over now, and we're seeing some negative divergences. The McClellan oscillators and summation indexes are negatively diverging. The parabolic SAR is negative. The Copic curve is negative. The bullish percent index for the NASDAQ 100 is now below 70 and declining. And the momentum for the NASDAQ 100 is also negative. Small and mid caps are negatively diverging from the S&P. That's when we take the indexes by themselves. And then discretionary is still negatively diverging from the S&P. The transports are still negatively diverging. And then we're in that period of seasonal weakness. On the positive side, so far, even though we're seeing some weakness right now, growth is not falling apart at this point. The oscillators are extreme positive, but they are declining. So we're seeing a kind of a mixed picture that way. The Vortex indicator is positive. Small and mid cap growth, even though it's been pulling back, is still holding up to this point. Another down day like we saw, and I might take that holding up so far off of there. The financial sector is positive. So our conclusion, we're positive, but we're still showing some weakness. We also want to be aware that we're in a weak seasonal time. That is what we're watching in the short term. If we see more weakness in the short term, that will probably bleed over more into the intermediate term. We're still overbought in the long term with our 150 and 200 period simple moving averages, but we continue to be positive since we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.